Welcome, everybody. It's always great to have you on these quarterly calls. This is our quarterly market recap and insights. And Kurt Brown is the Chief Investment Officer of Townsquare Capital. Most of you, if you've been joining these before, you've listened to Kurt speak before. We have some questions we'll get into. Kurt always has a running deck of slides that he keeps just live, ready to go at any moment's notice. So I usually get those slides a couple times throughout the quarter just to see what's going on inside Kurt's head. So this is fun. We're excited. I really want to keep this conversational. So if you have questions, let's just throw them in the Q&A and the chat. Now, if it's a formal question, you actually want us to address it, it's a topic, then put it in the Q&A because it's easier for me. I can see which questions I've answered and I can log them and say, okay, we answered that one live. The chat can easily, if too many people comment, it can just take it away in the history and I'll miss it. But anyway, we'll get right into it today. Kurt, I'm thinking I'd like to do a little bit different format if you're okay, because oftentimes we have you share your slides and then we just go through and see what questions come up. But given that we have several questions already, what if I just tackle those? Because I think some of these questions are the ones that people have been asking over and over and over again for the last 3 months. And so maybe we just tackle those and you can use your slides as you see fit. I'm not going to share, so you can just pop in and share whatever you want. And as you see fit, put up any slide that makes sense to answer these questions. Sound okay?
It's more fun for me this way.
Okay.
I do a lot of presentations, so this is way more fun.
Awesome. Okay. In more interview style.
Yeah.
All right. So I have quite a few clients that basically are just really nervous about how well certain stocks have done. And technology stocks in particular, US large growth, large technology stocks have just done fantastic. And we've heard about this, the top 5 stocks making up a massive portion of the S&P 500. And the idea is that, how worried should we be about that area? What should investors do? I guess my question is, if they worry about technology being overpriced, and yet at the same time, they feel like the world will advance from a technology standpoint, and there will be technology innovation that could create new businesses and new opportunities, but it just seems so expensive. What is an investor to do in this conundrum?
Yeah. And I think that implicit in your question, there's maybe 2 questions, but let me tackle the technology issue first. I don't have the slide prepared, but there's a great slide I saw a couple of months ago in a report on this exact topic. If you go back 20 years for the entire globe, the whole world, and you take every single industry in the world, and the only thing that you carve out is US technology companies. In 20 years, every single industry in the world is flat in its growth, except US technology is so astronomical in its growth that it has pulled the entire world's GDP up. So net in 20 years, the only actual real growth is from US technology, and it's not small, it's massive. And when you and I were going to business school, we learned about Coke and McDonald's and how you could go to any village in anywhere in the world and find a Coca-Cola sign. Everywhere I've been, that's true. What Google, Facebook, Amazon, Microsoft, etc., what they are doing is so much beyond even Coke and McDonald's. It's touching every device, in every hand, in every corner of the world. And the biggest 3 tech companies in the United States, their revenue, just 3 companies, their revenue is larger than every GDP in the world, except the United States and China. The size and the magnitude of the earnings growth in technology it's almost impossible for us to get our brains around. Each of these companies has hundreds of billions in cash now, just cash. They don't even know what to do with it. So yes, have they gone up a lot? Yes, but arguably it's warranted because it is the most unbelievable place in the world to be. And it's on par with anything we've ever seen. The development of electricity, the railroad, you name it, anything that changed the world, that's what US technology is. Now, the second part of that question is this a risk? Because they've gone up so much, does it put the market at risk? And the answer is yes. I'm worried about how expensive equities are. They are not cheap. And the leaders in that, of course, are large cap technology and even small and mid cap technology, you know? So what I keep sharing with clients is that in an environment where stocks are expensive, you have to have a portfolio that is prepared for sell-offs. We might not get one. I could see this going a couple more years before we see another major sell-off easily. But you have to have a portfolio that's built and prepared for that. And that's why as we go, we have to rebalance. You have to come back and buy value stocks. You have to buy banks when the whole world hates them. I've got to buy some European companies when everybody hates them. I've got to buy some bonds when everybody hates them. So you rebalance out of some of these profits that we're making in technology to prepare your portfolio sort of for the next phase. And you never know when that's going to come, you know?
And then, of course, if we do get the pullback, it's if you have rebalanced, you have the buying opportunity.
Exactly.
Yeah.
And by the way, we've seen that, as you know, in the past 4 or 5 months, if you abandon value and emerging markets and some of these things, you haven't gone anywhere in 4 or 5 months. But
Right.
if you rebalance some of your value, you've done actually pretty well the last couple of months. So
Yeah, that makes sense. That makes sense. We and I'm thinking about, I don't know how much our clients are aware of this, but in March, end of March, early April of 2020, we got on the phone with your traders at Townsquare and said, hey, all of our asset allocation models, all the models that have bonds and have international and have large cap, and we actually took a ton of the bond exposure that our clients had. And I say a ton, but we just basically rebalanced back to their original targets. And we ended up buying down at the bottom, really close to it within a week of the bottom. And it wasn't a ton of money, but it was, on a $500,000 portfolio, we figured it was about $5,000 that went from bonds and bought into stocks down there towards the bottom. And we figured it increased the value of those portfolios by $2,000 to $3,000 just for being ready, like you said, with the portfolio, having multiple asset classes and being able to transact when those markets move a lot. That makes sense. So then expand that same concept and conversation to more than tech, because there are a bunch of investors that say, it's not just tech I'm worried about. I'm worried about the whole bag. Like, how much should someone be concerned about overvaluation of equities?
I as you know, I'm a fairly conservative guy. I mean, we oversee a lot of assets here. Our clients have 22 billion in net worth. And I mean, that's a lot of money. And I stress about this. I'm a relatively conservative guy. So I don't like, as you know, a lot of your listeners know, I'm a former fund manager, co-managed a large cap growth fund for 13 years. Valuation was important to us. We didn't like investing in things that were too expensive. This is a market that's almost become impossible to find things that are cheap. And I think that's the point you're making. So there is, you never want to say in finance that there's something that's different. But the truth is that we are in a radically different environment for 2 major reasons that we literally have never seen before. Number one, interest rates are near zero. There's no textbook from the economics programs that have anything, you can't talk about it.
The discount rate they always had in mind was 7 to 9.
Right.
When you get your risk-free return at 7%, then you need to earn 12% to make it worth it. And it's like, well, risk-free return these days is negative 1% or 1%. Yeah.
Right. So number one, we don't have the luxury of buying safe bonds that make 6%. Right. I mean, you see what I'm saying? Like when I came up in the business, just give me a safe bond portfolio, give me 6 or 7%. I mean, can you imagine today? Just buy me some government bonds and get me my 6 or 7. And okay, so it's a new world. And the problem with that interest rate is that it's forcing us to look into other solutions. So every other asset is going to be more expensive because you can't hide in zero return assets. So number one, you have to be used to assets being a little more expensive. That's just the math of it, right? But here's the second thing. The amount of cash and liquidity that's in our system is completely unparalleled. Since the data has been tracked, high net worth families in this country have never had so much cash. In the meetings that I'm in through, day after day right now, the number one question is, I have more cash than I've ever had, and I don't know what to do with it. So you have these twin problems, and every day there's more capital that's finding a home. It's trying to buy real estate. It's trying to buy companies through private equity. It's trying to buy stocks, right? It's trying to find something. Are there opportunities? There absolutely are. And I don't want to get into them on here because it's probably going to be construed as investment advice to specifically say there's an opportunity here, there's not. But there are opportunities. But also our portfolio construction, Zacc's got to be a little different than it used to be, right? We might have to own some stocks that are a little more expensive than we like to in the past, but maybe own a little bit more cash than we used to in the past. Maybe we're comfortable owning some certain types of bonds or certain types of, private credit investments or alternative investments, or you have to get a little bit more creative in this environment. But what's happening, unfortunately, is that if you try to time the market and say, everything's expensive, I got to get out. Well, I've been hearing this for 13 or 14 years. You have been completely left behind. And if we get into an inflationary environment, which we very much could, the number one best inflation hedge in any cycle has been stocks. So it's a little bit of a conundrum. It's but you never can violate your own plan. Don't own more stocks than you can afford to have be volatile. But the ones that you do own, we have to just accept that they're going to be a little bit more pricey,
Yeah, that makes sense. I've seen people miss out on 30 and 40% run-ups waiting for a 10 or 15% decline, right?
Mm-hmm.
And then they finally get their 10% decline. They're like, oh, finally I can buy in. And they're buying in 25% higher than they would have, months and months to a years ago. It's a tough battle to be behind that.
Do you remember Peter Lynch?
Yeah, with
remember when we were
Fidelity, the
coming up
Magellan
early?
Fund.
Yeah. And Peter Lynch, one of the top 5 legendary fund managers in the United States,
Yeah, for those of you listening, this guy ran Fidelity Magellan and outperformed the markets just handily, just did incredibly well, like by 5 and 10% per year for 20 something years. And then it was nobody was able to repeat exactly what he did. I felt bad for the sorry guy who followed him. And I was in meetings. I used to work at Fidelity, and he would come to the conference room, and you could see the relative performance of Magellan, and it just his date, and it just got worse. You're just like, oh, I'm sorry, man. I think his name was Harry Lang or something like that. Anyway.
Peter was smart. He just rode off into the sunset at the top and never returned.
He was like Michael Jordan, but not coming back. But
right,
anyway.
exactly. He has a great quote, and I use it all the time. And his quote was, "More money has been lost trying to prepare for sell-offs than has ever been lost in sell-offs." Right? We can outthink this and out-trick this, because a lot of times, here's what happens. The last 3 quarters, almost all earnings across the board have been better than expected. So if you had bought into the COVID narrative early last summer, you left so much money on the table trying to be too cute and outthink things, right? So the thing is these are the best companies in the world, and they are finding ways to innovate and thrive and drive growth and things like that. So it does require some discipline and some patience, for sure.
Yeah, that makes sense. Okay, so we've covered a couple of these questions that I had, and I think we've tackled 2 or 3. So let's go. I'm going to move to somewhat of a new topic here, which is philosophy around the rate of portfolio turnover. I thought this is a question that came in this morning for this webinar in particular from one of our listeners here on today, and the question was, what are your thoughts regarding buying and holding investments versus frequently moving in and out of investments? And I have my own opinions, and I know Townsquare has a philosophy around this. So I'm going to let you go, and then I'll add some color, but it's pretty similar anyway, the way you and I feel about this, I think.
Yeah. Most movement in and out of things ends up not being good for portfolios. This is a very oversimplistic way to state it, but there's great white papers on this subject. And think about this math for a second. If you own 100 stocks in a portfolio, and each one of them is 1% of the portfolio, and you want to rebalance the 100 stocks. And one of the stocks goes from being 1% of the portfolio to 1.6% of your portfolio, and then you cut it back. What is that actually doing for the overall net worth of the account? No, almost no matter what happens, you can't actually move the needle a whole lot. The math of it doesn't bear out. Now, where trading might be a big deal is if you said, I'm only going to own 5 companies. They're each going to be 20% of my portfolio. Okay, now it's a big deal. Your timing becomes like a real issue, right? So in almost every case, what we see is that over trading is detrimental. You're going to probably end up being wrong many times. You're going to pay taxes you don't want to pay and don't need to pay, right? You get too cute with cost, right? So most of the time when you own great assets, you kind of let them move around a little bit and grow. And then when there's a meaningful rebalance, and you, Zacc, you referenced one we did together last year. And by the way, your timing was impeccable on this.
Well,
almost to the day.
We didn't mean to do it. It was scary. I'll tell you that. It kind of was scary but we realized, you know what, if it goes down further, we'll just do it again. And
Yeah.
so anyway.
But there was enough percentage of the portfolio that would change that discipline actually would matter.
Good point. Because we waited for like a 30% drop in the stock
Right.
market before we actually
Right.
did it. You could have been trying to do that at every 5% move, and it would have been a whole lot less efficient to go about it that way.
The second thing to ask yourself about any strategy like this is if your idea is to invest and own the world's best assets, they take time to grow. You think about what's happened the last decade with all these big tech companies. Even if you knew they were great, you know how many guys I know sold Apple 90% ago? And they were some of the biggest Apple proponents 15 years ago. Stock ran up a lot and they thought, oh, you know what? I'm going to get out for a while. It ran up a lot. I'm going to get back in. By the way, these are some of the best fund managers on Wall Street, and they didn't get back in, right? So sometimes you have to be just patient, letting your thesis develop and grow over time, you know?
Yeah, that makes sense. And when it comes to turnover, you know the numbers on this better, but most portfolio managers, I know that this is a big deal for Townsquare. You really strive to find low turnover managers, and they're hard to find, right? We're talking like in the 50 to 80% range, right? Of turnover per year for most of the funds out there.
Yep. And so the average active fund in the United States, depending on the window of time, like you said, is somewhere between 50 to 70% kind of average annual turnover, meaning that for every 10 stocks they own, 5 to 7 of them go out and new ones come in, right? So
every year, usually they do it on an annual basis, right?
Right. Every year. Well, that's not really that's not really an investment. If your average time of owning something is 7 months, is that investing? I mean, so one of our key metrics is we're looking for investment-minded professionals, right? So we want to see firms that are investing for something for at least 5 years. So their average turnover is going to be 20% or less per year to get that math to work, you know? And by the way, it doesn't mean they won't own something for 3 months. We've had several fund managers that have bought something, it worked or didn't work. The thesis is different and they're out. So it's not that they're unwilling to sell. So buy and hold is not the same as buy and hold forever, because very few things should be held forever. Think about this. I have this magazine. I used to be a trader on the New York Stock Exchange in the late 90s. And I had this magazine and it had the 10 companies, Fortune magazine, 10 companies to own forever. You know these articles that come out?
Mm-hmm. I'm guessing not that many of them are around, or at least that great these days.
7 of the 10 have been terrible investments since 1999.
Oh,
and I mean awful. It's like Hewlett Packard, like companies that are barely surviving anymore, you know? So WorldCom, remember WorldCom?
Yes.
I mean, there's all kinds of so even Apple will have its day where it's a stodgy, big, boring company. It'll eventually be Procter & Gamble, right? But for today, it's still a driver, you know?
So when it comes to, so of course we're looking for low turnover. Now, among the suite of investment options, we do have some clients that, you know, through Townsquare, we get access to a few managers, but that will trade a little bit more frequently. To maybe give everybody here kind of some background, what you're talking about if you are investing like Kurt has spoken thus far, is more of a strategic allocator. You're looking for a specific type of company of a specific quality or a specific factor. Maybe they pay dividends, or maybe they have a certain amount of fluctuation, and you're going to hold on to those until those stocks no longer meet your criteria or your standard, and then you'll research and decide on how you'll sell. That's called sell discipline. And sell discipline is every bit as important, if not more important, than buy discipline. It's really easy to buy things. It's really hard to sell things.
Yep.
And so it's hard to know when you cut your losses when it goes down, or when do you cut off the winner after it's gone up. Those are really tough decisions. But that's all strategic allocators. And then there's tactical allocators, which we've talked for the most part that isn't as successful or doesn't work that great. There are a couple strategies that some of you may have that we put in small doses in the portfolios. If you are interested in the portfolio doing a very specific thing, like
Yeah.
momentum, like following some specific asset classes as they are moving and moving quickly. And there also are strategies, like we have one that we've talked about Saratoga in the past on this platform, where they put money into short-term bonds when they can't find stocks that they think are worth buying. But that's kind of still an investor mindset. It's just, I can't find anything I really, really love to buy at the right price, so I'm just going to hold and wait with some cash. But some people might consider that tactical. But even Saratoga is not high turnover. So
Well, and I'm glad you brought that up. We should clarify that when we say tactical's typically not as good as an investment-oriented strategy, that's only in comparison to how the market performs. But oftentimes we're trying to use an investment as a tool, and we're not actually even trying to beat the market.
right.
So let me give you an example. We have a fund manager that exists never to have a large drop. And if they make money, that's great, but they're never going to have a large drop. And that's actually why we use them. And so in 15 years, the largest drop they've ever had is 3 or 4%. Now, they've only averaged about 6.5% return a year,
Which
a lot less than the stock market.
which we have quite a few clients that use this particular strategy, and
Yeah.
they're not trying to make as much as the stock market. They're
Right.
just trying to have a conservative positive return.
Yep.
And it
And it's
works.
great. It's
Yeah,
great.
that works well. Okay, so hopefully that answers the question about turnover. So generally, low turnover is better. We like investors rather than traders, and we like investment strategies that target specific fundamentals when possible, meaning the quality of businesses and the quality of stocks and bonds. Okay, so how do we factor tax considerations into trading practices? This is one where the tax portion of trading is probably more of a coordination between Capita and Townsquare than the exact investment allocations in trading. So, for example, we don't at Capita, we don't pre-approve trades that need to happen within the portfolio for investment decisions. For example, if one of your large cap stock managers says we need to pull a little bit out of Adobe and we need to put it over in Microsoft, we're not expecting, and we don't want Townsquare to call Capita and say, "You okay if we go ahead and place this trade that everybody says we should do?" So just
Yeah.
be aware, like that's happening direct, and we like that. So it's called model delivery. And the tax portion is so individualized per client that we have to have a lot of coordination with Capita to make that work. So, for example, I have some clients who want to show capital gains because they're trying to use up some sort of charitable carry forward loss, or other, capital carry forward losses, or maybe their business is showing a net operating loss and it's time to do it. Or I'm not sure if many people understand, but in the lowest tax brackets, your capital gain rate is 0 for long-term capital gains. So there's some opportunity to purposefully show some capital gains if your income is low, or if you're having some sort of loss carrying forward from charitable business or capital. That's very individualized, because those are probably only like 5 to 10% of investors. The other 90 to 95% of investors are feeling an immense pain when they see high capital gains within their portfolios. And so we're trying to reduce those as much as possible. So multiple times per year, Capita requests of Townsquare a list of our non-IRAs, so non-retirement accounts, and we look at all of the individual positions within the portfolio and the gains, unrealized gains and losses within those portfolios. Townsquare does some analysis for us and highlights the largest ones that have the largest downside, the largest loss. And then Capita goes through the individual advisor of the head lead advisor on each account goes and looks at that and says, I know this client's tax situation from our conversations, and this person could be using some capital losses. Let's go ahead and harvest those losses. And then we rebuy another investment. So if the market comes back up, you'll still experience gains in the meantime, but you can't buy it back within 30 days or the IRS disallows the loss. That's called a wash sale. So we buy it. Then after 30 days, we can flip the switch back and get back to our preferred position. So that's actually a very manual and quite cumbersome process for us to go through. So we actually usually stage it to about 10 accounts per week per advisor. So in between their appointments, they can review a couple of them and send them over to Townsquare and have them trade and execute. And we have about 4 or 5 people at Capita that touch that. This Kurt knows, like, we're the machine at Capita. So like any process like this has its formal and defined steps and roles. And so one person gets an Excel file ready, next person reviews, next advisor jumps in, approves, just, or makes changes, and then security replacements, and then we send it off to Townsquare and they trade. So there's a lot of work that goes in. That's how we manage capital gains and losses. And then beyond that, we like to use individual stocks when we can, because there's more control over the tax liability. And then when we can't, or when we feel like we want to just get broad diversification, everybody differs a little bit here, but we really love the passive approach, because in exchange traded funds, you see very low distributions. You can buy a mutual fund that has owned Apple, like Kurt has talked about, for 20 years, and they might finally decide it's time to cut and take their losses and run. Well, and they sell that. You buy it, a week later, they sell Apple, and they now have to distribute the capital gain tax liability to everyone in that fund, even if you've only owned it for a week, for 20 years worth of capital gains. So that's brutal when this happens to you, if you've ever seen massive fund distributions and tax liability. So we tend to like a little bit more tax efficient methods of owning individual stocks or exchange traded funds. They tend to do less mutual fund distributions. We go passive investments with the exchange traded funds and active investments with the individual stocks. So that gives you a summary of how we factor tax considerations into trading practices. If you're thinking, gosh, I don't know if my advisor knows enough about my tax situation, you might be right. Bottom line. So tell us, call your advisor. And the best thing that we do now is we have software that analyzes tax returns. So you just hand us your 1040 and we'll throw it into our software, and it will analyze and tell us exactly, where you're at with different capital gain limits, where you're at with income limits, if your Part B premiums being, hiked up because of a surcharge. I mean, we know all that stuff if you hand us your tax return. So we're happy to do that. Kurt, is there anything on the tax side that you would add? I feel like that's probably more on our side to ensure that goes well, but is there anything else you would add?
No, I have one little graphic here that I people always find pretty interesting, and sometimes we forget to look at, right? And I'm going to zoom in on this thing here a little bit so people can see this. This is an example, something I've used for a couple of years. This was 2017, and the S&P 500 was up 22% that year. Okay, but what happens is you and me think, oh, it's great. I was up 22% in my S&P 500 index fund or whatever I own in the market this year. What's interesting is in this year, 80 of the 500 stocks in the S&P 500 were down, and look how much some of them were down. So sometimes a tool that we'll use is we'll want the clients in a taxable account to actually own the stocks, because here's what you could do. You could be up 22% on the year, and you could still go in and tick off some of these big losers, sell them intentionally, and lower your tax bill or completely remove your tax bill for the year. And this is why this works. And I just like to show this graphic, because a lot of times we think, oh, the market was up a lot, everything must have been up. But actually, in almost every great portfolio, there's some things that are down. And so we want to try to optimize that for your tax benefit. So I'm 100% with Zacc. I'm actually surprised how many tax professionals and financial advisors don't utilize this tool. I've been doing this a long time. We used to run a big fund. A lot of people put money in our fund, and a lot of really high net worth families, they didn't even know they could be saving lots and lots of money every year, finding little ways to intentionally book winners or losers before the end of the year. So,
It's
Zacc,
weird.
I'm glad you brought that up.
It's weird too, Kurt, because every once in a while we'll do this work that I find to be really helpful for clients' tax situation, and the accountants will be like, "Gosh, why are they doing this? Why why are
Yeah,
they
yeah,
generating all these losses?" It's like,
yeah.
because it's helpful for the client. They didn't actually lose money. The account's up, but we just picked apart a couple
Right,
losses here and there, and we just
right.
didn't sell the gains. I had a client at my previous employer that I worked with. He was in the early days of Apple, and he had an account that we managed that was $25 million. And this was back in 2008 when the market dropped. So in 2008, we went in and harvested losses, and we harvested $7 million worth of losses. Now that's actually really good, right? Oh, 7 million on a $25 million portfolio when the market got cut in half is not that big of a deal compared, but to most of us, we're hearing 7 million and kind of like breathing deep, right?
Yeah.
Um, and he and in the rule, as many of you may not know, but let's talk about it for a second, is that you can only use up to $3,000 per year against your ordinary income. And so some people will just put that in their head and think, well, that guy's never going to use it. I mean, how many lifetimes would it take to use $3,000 a year up to $7 million of assets of losses? And we got that question every once in a while, but the client was very savvy and he knew, because you can use up to unlimited amounts against capital gains. So within about 2 or 3 years after 2008, he had enough activity in his portfolio needing to move money around that we had used up all $7 million worth of losses. It just bought us about 3 years of trading without us being handcuffed for tax reasons, which was nice.
Yep.
And if we hadn't done it, if we hadn't sold off those losses at that time, and if we had just waited and the market had come back, he would have been paying taxes for those 3 years on trades. So anyway, you get
Right.
the idea. There's some opportunity there. It's called tax loss harvesting. If and it's funny because sometimes us advisors will give our statements to our accountants, and they'll think, you advisors, like, you never show any gains. Are you guys actually making money in your portfolio? We're like, well, yeah, we give away all our winners to charity, and then we sell all our losers for our own tax bill,
Yeah,
and it
yeah,
works out great. Anyway,
yeah.
hopefully that answers that question. Let's talk about cryptocurrency for a minute. I want to just get this out because I'm getting this question every single day now.
Oh, yeah. And
And
Coinbase is offering today. It's a
exactly, the
timely thing to
IPO
be
is
talking about.
perfect. So for those of you who don't know, Coinbase is a platform on which you can buy many different cryptocurrencies. And of course, Bitcoin is the one that you're hearing about. So if you're thinking what exactly is cryptocurrency, Bitcoin is the most popular one. I'm gonna do an okay job of explaining this because nobody fully understands everything about crypto. And then I want to know your opinions on this, Kurt. I think it's something to pay attention to. I think it's something to be leery of taking too much risk. That's my summary before we begin. When it comes to cryptocurrency, I have a lot of people trying to get a feel for what it is, and so I've been trying to find good ways to explain it. Basically, it is a way of transacting on platforms in which there is incentive of all the participants to verify and log those transactions, and the participants themselves are all verifying all these transactions. This is called the blockchain, and that in and of itself decentralizes the finance. So you're basically not needing banks anymore to verify that the money's moving from the right place to the right place and to clear the transaction like an ACH or a wire. You have everyone doing that. And it can be, and you don't have to disclose your names. You have just numbers that you're transacting between. And years ago, I started watching this, and I remember thinking like, wow, this is really cool. And the way that people were getting Bitcoin is by logging transactions. That's mining Bitcoin. So if they mined more by keeping up the blockchain, then they were rewarded with more Bitcoin. So these people started to figure this out, and they created warehouses full of computers. So believe it or not, I'm actually like, well, can I go mine Bitcoin? This is cool. I'm going to go do it. And then I started researching it and realized that these people were buying warehouses full, like of computers and pumping in air AC units to get the computers as cool as possible because they were so hot from trying to work so hard to mine Bitcoin. I'm like, oh, this is an enterprise activity. This isn't a in your basement playing around on your laptop activity. Um, so that's how Bitcoin works. Now, it's an algorithm, and this is where my knowledge starts to peak out because there's some mathematical algorithm to quantify that there's only so much Bitcoin available. And that limit of its source or quantity makes it what some people believe to be a store of value and makes it worth something. But it's only worth what everyone else is willing to pay for it. So this is where you have to be really comfortable with the concept of if you put money into it, there is a chance it disappears. I mean, for years I've been thinking about the risk here, right? What if the governments come in and say this is way too easy to launder money? This could actually facilitate sex trafficking and human trafficking. Like this is not okay, and they just shut it down. Like that takes the price of cryptocurrency down pretty quickly. I don't think that's the route it's going because we're actually seeing governments trying to get more involved because the technology associated with blockchain is extremely powerful. And I think a lot of financial institutions will mimic some of the technology and institute it in their own businesses. So the other thing to realize is that it's more than just Bitcoin. Like Ethereum has ways that you can tie code to the cryptocurrency. So we're starting to get kind of crazy here, but like you can tie code to it and you could actually have certain contingent contracts built into the conditional statements, the code on the cryptocurrency so that you could between two parties agree that in certain circumstances certain value exchanges in certain ways that you can see the applications of this are pretty broad, but it's extremely risky. So what do? I just take a couple $100 a month and I automatically buy it for fun just because I don't want to be the guy. Like I feel like there were probably a lot of people out there that were like, yeah, the internet's not going to stick around. And they're like, internet's not going to really be that big of a thing back in the 80s and 90s. But here we are, and it's everything, right? And I don't want to miss out, but I also put such a small fraction of my wealth into it just to watch and see and enjoy. And I buy a couple different currencies. And it's not something that I would put much of my wealth in. I'm have to pause there to not go too far into investment advice on a broad scale. This is not advice. I'm just saying it is something interesting and you're valid for asking these questions, but let's be aware of the risks of involved, and then it's called position sizing. So you size your position and your wealth according to the risk that you're willing to take. That was a long explanation, Kurt. After that explanation, what would you say? Like, what do you think, and where's your head at with all of this?
Hey, first of all, that was a great explanation. That was
I'm
actually
trying to figure it out.
That's pretty good. It's hard to explain crypto and blockchain without getting way off into the weeds. My standard comeback is typically what's not to love about any technology that was actually invented by money launderers and drug dealers. That's my typical first response. And at the risk of sounding overly pessimistic, I'm going to be more pessimistic. And that is that number one, it's not a currency. Everybody that owns it converts it back into US dollars to spend it.
A good point. I keep saying the same thing. Like when I can go in and buy a hamburger with it, then it's a currency. But right now it's like, okay, that hamburger costs 0.00000071 Bitcoin.
Yeah.
That's not even going to work like that. I'm sure they'll figure something out though. But
I have this great article. I was sitting here trying to find it. The biggest blockchain conference 2 years ago in the country, you couldn't pay you couldn't pay Bitcoin to attend the conference. You had to pay US dollars. Well, what the heck? I mean,
sorry, I interrupted you. You were going through a list though.
Number two, the average transaction cost is $9 per transaction. If every time I went to the Maverick to fill up with gas and it was $9 every time I swiped my Visa, that's a problem. Third, this is the largest indictment, is that the IRS taxes it. So if you put US dollars in a checking account and that US dollar goes up against, let's say, the Chinese renminbi, right? You don't pay capital gain. But if Bitcoin goes from 40,000 to 50,000, you pay cap gain.
Sure.
So there's nothing about this that's treated like currency. Okay. Secondly, it does disappear. You see it all the time in the news, 30 million here, 50 million here, 100 million here, gone, vaporizes. No one knows where it went. Third, the government in our country always gets its pound of flesh. It will control it, it will regulate it, and it will tax it. It is always the case. And if it doesn't, you're out and you're not playing ball here. So, okay, that's all the negatives. Now, I remember I was on the floor of the New York Stock Exchange in the early 90s when everybody was talking about the internet. And I remember saying, literally, I said, what do I need email for? And I remember going home and logging into my AOL dial-up modem in my fancy condo in New York and thinking, well, I don't even know what to use it. I'm logging in because it's cool and I have nothing to use it for. If my internet goes down for 1 hour in my life right now, I cry like a baby. Right. Okay. But massive wealth was destroyed chasing internet companies in the 90s. Okay. So here's my counsel. I own some crypto, own a little bit. I just own a little bit, right? Because if you're right and you own a little basket of crypto and it works and it becomes the internet, then that little 1% of your portfolio is going to be 15% of your portfolio later, right? I mean, okay, if it vaporizes, okay, it was 1% of your net worth or your portfolio is fine. It's like the internet to me because you don't know what the winners and losers are going to be. You just know it's a really killer technology application. And we have no clue yet how it will actually end up playing out. And anybody who pretends like they don't know. I remember I worked at an investment bank that brought pets.com public. It blew up, went to zero. $8 billion in market cap was vaporized because it was a stupid business model. You just gotta be careful.
And wait, I'm gonna go back on that because I think on that pets.com. Did you say it was pets.com or pet.com?
Yeah, something like that. Yeah.
Here, let's talk about what that means though, because I think people hear 8 billion vaporized, but let's talk about how that happened. So individuals who have started this entity and basically put a .com after it, go public with this entity. Yep. And who's putting money in? It's all of us. It's all of us individuals trying to figure out if, like, with some FOMO, are we going to get in on this ride? And we buy it. Those individuals walk away with millions and millions, if not billions. And then the market just takes that down to zero. So the loser is the general public, and the individuals bringing it to market are the winners here. So that's, I think sometimes people, when we talk about like losses and how money just evaporates, like where it hits home is usually the people who find out about it late, go in and buy too much of it, lose a ton of value, and they're stuck holding the bag.
Let me say one other thing about this, because you got to remember what we're trying to accomplish. Everybody that's on this call, all of us, every client of Capita, we're all trying to accomplish the same thing. We're building net worth. We're trying to grow it in a responsible and fairly safe manner so that we have a better quality of life and lower stress. That's really actually what we're all trying to do. What I notice happens sometimes is people feel that they are getting left behind. They're being left out of an investment. There are amazing investments everywhere. It is nobody's obligation to feel like you have to get them all. You can make a tremendous amount of money in one investment. We have clients that have made every penny in their life in a single business or just in real estate. You know, I know a guy that has only invested in one type of company, deep water jack-up drillers. The guy became a multimillionaire. He knows it like the back of his hand. The guy used to work on the platforms in the Gulf. So there's lots of ways to make money. We're trying to do it in the most responsible, sort of diverse and safe, risk-adjusted way. So we all have to fight. Me too. We've all got to fight the temptation to feel like I'm missing out, because there are a lot of investments I'm going to miss, and I'm totally fine with it. Like we have a fund manager, Zacc, that has never owned Amazon. It is a growth stock manager that has never owned Amazon. And every time I meet with them, they say, yep, we never bought Amazon. We blew it. And this fund manager is in the first percentile of fund managers for almost 30 years. They're one of the very best in the business, and they just laugh about Amazon. We just missed it. We were wrong. It wasn't our kind of thing. And you have to be okay with that. So really, we got to fight that temptation. because it's all in the media right now. And now we've
For
got things
sure.
like NFTs and other crazy investments and things like that. And it can drive you absolutely crazy.
And you've talked about this before, but the saying in our industry is when we start getting asked about it, it's too late and it's time to sell. Because it's a little bit behind. But anyway, who knows?
My dad doesn't know how to use Zoom, so I know he's not on this call. But I know when my dad's asking me, it's time to sell the asset. Like
Right.
that is the end of the line. And the other day he's asking me about what's Bitcoin. I'm like, that's it. I'm selling all
I'm
my
out.
crypto. I'm out. That's it.
Oh my gosh, it's true. So in summary here, don't take on risk you shouldn't. Don't risk the farm. You've worked so hard on this. Don't take on the risk you shouldn't. It's like the GameStop thing. I talk to people on the
Yeah.
podcast. Don't mess around with it. But
Right.
if you are willing, like for me, my number was, a couple to several $100s a month. Like that's like I take my family out to dinner and it costs that much. So
Yeah.
to me, that's not a big deal, and it's kind of fun, and I can log in, and it's mostly my tuition to see what it does because I won't pay attention as closely if I don't have money in it. And you
Right.
can see how everybody's a little different with how they think about this, but position sizing is important.
Yeah. Yeah.
I think we got that. All right. So that was awesome, Kurt. Thank you so much. Let's talk last minutes here and any questions that come through. If anybody has any questions, I've been watching. It's been kind of quiet. We've hit a lot of the pre-questions, but if anybody has any, throw them in there right now. Kurt, would you maybe do a summary for us and you can show slides? Oftentimes you have a set of slides that show like what we're thinking about, what we like, what we don't like. Maybe you could show that, or if there
Yeah.
are a couple slides that you think, you know what, this is what I would focus on right now in the economy. Let's just open it up to you for the next 10 minutes and then see what
Yeah.
questions come through.
Yeah. There are probably a couple things I'd like to hit on real quick before we end that I think are thematically are super important to what's going on right now. Let me share my screen for a second. I'll just hit a few key slides. You know what? That's not the right one. Let's see.
While you're
You got to
working on
get the
that, you take your time in getting that up. Another question that did come through is anticipation for markets given the new president. So
Oh
your
yeah.
thoughts on Biden and markets?
Yeah. Let me hit a couple of these things. Oh, you know what? I'm going to hit the Biden thing first. So here's what I would say about that. And we did. You might remember last year, people that were joined the calls last year before the election. There is absolutely no correlation between political parties and capital markets, and I mean zero. And by the way, I have my own political views, and I'm passionate about some of them. But as an investor, the political parties there's no correlation. That markets have done great and poor under every type of thing you can imagine. And I hate to say it, even with taxes. And man, I do not want taxes going higher. I just don't. But there's actually no correlation between rising and lowering taxes in that. I mean, now I have my bias and I'm going to make a pretty impassioned case. But my point in sharing that is if the political tail ever wags the investment dog, it typically ends up being wrong. And I think with the administration, there's two big themes. One is potentially very good for markets, and one maybe not so much. We have seemingly, Zacc, and I'm going to stop sharing here for just a second, but we have seemingly got into a place where no political party has any interest in not spending money. And I remember when 09 hit or 08 and the financial crisis happened. And I remember how bloody Congress was over TARP. 700 and we're trying to get 700 billion. You think we created 5 trillion in the last year. We tried to get 700 billion and it was a bloodbath. We almost shut the world down on this fight about creating stimulus. And now both political parties are writing checks by the minute. And it is just create dollars, create dollars. So this is a new world. Like we haven't seen both political parties willing to just say stimulus and throw dollars at the economy, right? So we're going to see an infrastructure package. I actually don't think we're going to see a stop anytime soon to stimulus. So you're going to pay people to sit at home on their couch and not work. And I've got clients that own businesses that are having a hard time hiring with millions of people sitting at home on their couch.
Oh, Kurt, I have a quick story for you today about this. I met with my builder. I'm building a home. And he said, you know what? I have a framing crew of 13. It's down to 2 people because all of them got stimulus checks. And he said one of them got $4,800. And he said, I don't have to work for the next month. And so he just is not showing up for
Yep.
another month.
Yep. We're hearing it every single day
crazy.
right now. It's going to create wage inflation. This is going to be part of the inflation problem. So at some point, Congress needs to get off of this. We need to get the economy more normalized. But that's not going to happen anytime soon. No one in this administration has interest in that. But you are going to see big infrastructure spend bill. It's going to help the stock market. This is all going to help the capital markets. Now, the flip side is the tax thing, and that's probably a little bit of a headwind. And depending on how aggressive the tax policy gets, it could actually start to matter a little bit. Historically, it's been hard to get really aggressive tax packages passed. And if you have millions of people sitting at home on their couch, it's a kind of a hard case to make jack up taxes, even on the wealthy. That's going to play itself out. And that's all I really have to say about politics.
Okay, that's great.
It is what it is. Let me show you a couple of things here that I think thematically are massive. The media might not necessarily want to talk about it. The big one is this. This U.S. savings rate is unbelievable. So we now have done these 3 big rounds of stimulus. It looks like about a third of every dollar so far in stimulus has been used to put into a savings account or pay down debt. Jamie Dimon talked this morning from JP Morgan. He gave this stat. This is stunning. In the past year, the amount in the checking accounts at JP Morgan, the largest checking account bank in the United States, the deposits are up 24% in 1 year. Loans issued down 4%. He says everything they are seeing is people paying down debt and saving, not trying to borrow more money. That is not a speculative bubble-like economy. This is an economy that is still nervous, with people still sitting on their hands and holding all the cash they can. Here's what the money market funds look like. They are bloated. Okay, why am I hitting on this so hard? This cash has got to go somewhere. People holding these levels of cash will not be patient with zero interest. These people are making no money. This is a holder. They are literally just sitting it there. And in fact, there are many banks that are starting to say to corporations, if you're going to hold $100 billion in cash, you're going to pay us. We're not paying you because we're paying for the FDIC insurance to back all your funds. You're going to pay for the insurance now. That's how much cash is in the system. The banks don't need the cash. They don't even want the cash anymore because they can't lend it out and make money on it. Like, that's the bizarre world that we're in right now. Okay, this right here, this is what's called the velocity of money. This is a measurement of how many times a single dollar goes through the system in the US in a year. Okay, it has never been this low. And what it is showing you is that even though the dollars have been created in mass, they are being parked in money markets, in bonds, in cash accounts. They're just sitting. Even US corporations have never stockpiled this much cash. Okay, this is incredibly bullish for capital markets and investments. And I know the market doesn't feel cheap. Housing doesn't feel cheap. All this doesn't feel cheap. The problem is this money's coming to work. You know, my clients are calling me and saying, what am I going to do with all this cash, right? I mean, this thematically, Zacc, is a major, major deal.
And I think it's in opposition to 2007 and 8. The difference is that there were so low of cash levels and people wanted to borrow like crazy, and not only borrow, but leverage as much as they could and borrow as much as they could compared to their household asset level. So that's where I think some people get really concerned. Is this a bubble? Is this a bubble? But goodness, like you look at how much, oh, this is it right here, isn't it?
Yeah.
There you go.
Yeah. Look at that, Zacc. You just said it. Look at the difference from 2007 with the average household in this country, their assets to their liabilities. I mean, the average household is in a massively better position than they were in 2007.
So let's decipher the numbers here. So we're saying right now, household assets to liabilities, they have 3 times as much assets as they had liabilities back then. And it was it was really close to 1-to-1 back in, they were half leveraged in 2008. Whereas we're 3 times assets to liability. So hopefully that helps you get a feel for individuals' positions is so much better.
Look at this. Okay. In 2005, 6, 7, this is right before the real estate market collapsed. Okay. The average FICO score of a mortgage borrower, look at it. Almost nobody was 760. 20-something% of the mortgages going out the door in 2005 were in the highest credit score, over 760. Look, the banks are only giving mortgages to the highest credit scores right now. Okay. Here's another chart on this. Okay. This is the low credit quality group. Okay. Look, pre-financial crisis, they were lending money to everybody with a pulse. In this cycle, the reason I'm not worried about housing creating a crisis, now it's expensive as all get out, but there's no crisis because it's the best balance sheets in the country are the ones borrowing the money. They're the ones actually buying the homes and the real estate, right? It's not the subprime. It hasn't even moved, right? Look at this, okay? 10 trillion in US home equity in 07 with 9 trillion of mortgage debt. Remember that 1-to-1 you just talked about on the other slide? Look at today, 21 trillion in equity, and still we've barely moved the mortgage needle. So the average house, by the way, almost all household net worth is stock portfolios and retirement plans and their house.
Primary residence. Yep.
Those two things are really shoring up the financial quality of the average household. We are in the opposite position, Zacc, than we were in 06, 07. I mean, completely in the opposite realm. Now, I'm not saying the market can't go down. I'm just saying not
just for a different reason. Yeah. It'll just be some other reason, right?
Yeah, 100%. 100%. Some other things that you won't see real quick. This is U.S. inventory, housing inventory. There's just none. There's none. This is a major part of the problem. Everybody wants to buy. Mortgages are at 2.8 or 3%, and there's no houses to buy, right? Let me show you one or two other things. A lot of commentary about margin debt in the stock market, that the stock market's getting too frothy. It's not true. There's more margin debt than there was in 06, but not as a percentage of the market and not even close, right? Okay. So the market as a whole is bigger now. But the percentage that people are buying on borrowed money, that's what margin is, borrowing money to buy stocks, is actually lower than it was in 15 years. A lot of job postings, a lot of companies trying to hire. You can't cheat that. That's bullish. I'm trying to hire. You're trying to hire, Zacc. I know that. A lot of companies are trying to hire. Look at travel. Look at TSA throughput. Boom, big bounce. People are flying again. People are driving again. There's gasoline demand. This is genuine economic growth right here. These are numbers that you can't cheat. Look at revolving credit at the household level. People don't want debt. Jamie Dimon talked about this morning. In 05, 06, 07, people were buying the third motor home, the fifth house, the whatever. Today, if you have cash, you're trying to make your financial position even more bulletproof, more stable, more. Look at that. We haven't had revolving credit numbers like that, Zacc, since you and I have been alive. I mean, it's like that's the position. Anyways, that's it. Those are kind of the main things that I wanted to share.
I love it. I think that's wonderful. And so I think in summary, I mean, you and I are always going to say this, but there'll be a reason when the market for the market to drop 10, 15, 20%, it happens on average about 14% every single year at some point. So don't take all these bullish signs as market can't go down, but recognize that the pricing in the market, yes, while expensive, there are reasons for the market being so expensive. I think that's the biggest feedback I get from people is that this isn't right. This is just totally unnecessary. And the pricing is totally fake and it's all propped up by the federal government. And yeah, the federal government has had a massive influence and provided immense liquidity and low interest rates, but companies are doing really well and individual households are doing really well. And those two things are really causing stock prices to be somewhat expensive, above average, let's call it.
And the fundamental, make no mistake about it, as tragic as COVID has been, and as brutal as it's been on livelihoods, our economy, whatnot, the data for the last 9-10 months in our economy is so much better than the media would have you believe that it is. And that's why I show these slides. And Zacc, if you want to send these out to clients or whatever, I'll make them available to you guys.
That'd be great. Some people ask for it.
Yeah, the data is better. So you can't buy into this narrative that now maybe stocks are kind of expensive, but it's not built on hype. It's not built on speculation. It's legitimate expansion and growth. It just happens to be a little pricey right now. So, yeah.
That's perfect, Kurt. All right, we'll wrap up right there. I'll put this recording on the website. And by the way, if you guys haven't checked out the new website, you've got to check out the new website. We had a massive day the other day. We got a new website. We have a billboard. Just so many new things. We've been hiring and growing, and it's wonderful.
Am I allowed to break the news about the assets?
You can say it. Yeah.
That was how I was gonna close today. Congratulations I've known these guys for many years. I remember when Capita was a lot smaller firm. They crossed $1 billion in assets that they're managing for you guys, for clients on the phone. And that is a big deal. Less than 1% of wealth advisory firms in this country ever get to that level, far less than 1%.
It's kind of crazy where they say there's a dangerous middle between about 200 and $1 billion, that if you can make it through that no man's zone in the middle where you have to all of a sudden become a team instead of an individual advisor. Anyway, pretty exciting. Thank you, Kurt.
Congratulations. That's cool.
Thank you very much.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.